Who has statements in a foreign currency? And we're going to learn how to convert them to Canadian dollars in order to consolidate. Statements with hours. So that's what this entire chapter is about, and you'll find it's pretty straightforward. Overall, especially since you've got an open book exam. Okay, so Part A, Introduction to Foreign Currency Transaction. So it deals with foreign entities' financial statements, translating them into the parent's presentation currency. So 3 major issues: what the functional currency of the foreign operation is, what the presentation or reporting currency of the parent company is, and where the resulting translation adjustment or foreign exchange gain or loss should be reported. Because it's either going to be OCI. So accounting translation exposure exists when financial statement items are translated at the closing rate or the forward rate. So as we saw in 10, there's risk because there's uncertainties when rates change and so on. Transaction exposure exists when there's a lapse in time between the origination of a receivable or payable and the settlement, so there's a time lag. Economic exposure is the risk that the value of the entity could decrease due to a future event such as a change in currency rates. Now, this economic exposure depends on whether the foreign subsidiary is closely linked, in which case they're integrated with the parent, so their ops directly affect the parent, or whether it be self-sustaining. So not as much risk to the parent. So there's 2 major methods for translating foreign options under Canadian GAAP. 1, functional currency translation, FCT, and presentation currency translation, PCT. FCT method translate the financial statements of foreign corporations from the recording to the functional currency, and it's used for integrated operations. It used to be called the temporal method, and that was recently. Hear that in practice. Temporal method, that's just FCT. Translates the statements from functional to presentation currency and is used for self-sustaining subsidiaries. And this method used to be called the current rate method. So again, you're going to hear them both in practice. In this chapter, I'll focus on FCT and PCT. You can just read about this. And on page 2 is a little chart. In order to determine which method to use, we have to know whether the foreign subsidiary, or don't forget it could be a joint venture or associate, is self-sustaining or integrated. So they use the functional currency of the entity to determine. So if the functional currency of the foreign entity is the same as the parent's, so in this case, the parent's is always going to be in CAD. If they're CAD, then they're integrated, and you use FCT, and the exchange gain or loss will be reported in net. However, if the functional currency of the foreign entity is the currency of the country where it resides or some other country, but not Canadian, it would be self-sustaining. You would use PCT method or the current rate method, and the gain or loss goes in OCI. So, we touched on some of this in Chapter 10, but we're going to expand on it now. So, the functional currency of a foreign operation is determined as follows from Chapter 10. Now, that's Exhibit 10.3. So, these are the primary 5 categories we looked at earlier, but these are the additional factors we also need to consider. So you're looking at a foreign, say, subsidiary, and if their functional currency is the Canadian dollar, then they are integrated. But if it's not the Canadian dollar, then they're self-sustaining. Okay, so looking at the sales price, and it's not just price, but also the market. Do sales occur in denominated in Canadian dollars? Well, if that, it would be, functional currency would likely be Canadian. If they occur in foreign countries, and in foreign currencies, then it's not the Canadian dollar, so they'd be sustaining. Operating costs, labor and materials obtained in Canada, denominated in Canadian dollars, integrated. If they're not, self-sustaining. Competitors are mostly Canadian or listed on a Canadian exchange, integrated because the Canadian dollar is the functional currency, or it's not. Financing, debt and equity instruments issued in Canadian dollars, then it would be integrated. If they're issued in foreign currencies, it would be not. Operating expenses, surpluses, excess cash is retained in Canadian dollars or in foreign currencies. Now, just looking down at the next ones, the extension of the parent. How closely are they related to the parent? So, only goods imported from the parent are sold. Again, this is integrated. And this would be self-sustaining. Autonomy, the parent dictates the operating procedures, or they have a lot of autonomy. Lot of intercompany transactions, low number. Cash flows of the foreign operation directly affect the cash flows of the parent, or they don't. Financing, parent provides cash to pay obligations, or cash from local operations is significant to pay obligations. So really, we're looking at it, are they integrated? Are they self-sustaining? So I want to write down a little example. So let's say we have a sub in Mexico. And I'm just putting some factors down. Sales and inputs are in pesos and Mexico. The competitors are foreign. Financing is in Canadian. Surplus is in Canadian. Oh, sorry, I wanted to make that pesos. Only goods imported from parent sold. parent has sent upper management to run the sub. Parent provides, can't write, that says provides, oh my goodness. Cash for operations. And the cash flows affect the parent. So this is our little sub, and these are some factors about it. So what we need to do, or what you need to do first, is go through this list in between these two videos. Go through this list and tell me if each of these factors indicates that their currency is the Canadian dollar and therefore they're integrated, or they're self-sustaining because they're functional, not the Canadian dollar. Okay? So bear in mind, as we talked in Chapter 10, even if a company was integrated, they could report using any currency they want. So their reporting might be in foreign currency, and so then we'd have to translate it when we're trying to do consolidation. So reporting currency, that's what we're pretty much looking at here. We've got their statements in whatever currency they report in, which doesn't matter based on this. What this tells us is which method we should use to translate those foreign numbers into Canadian dollars so that we can consolidate them. Okay, so take a couple minutes, go through this, tell me if each of these indicates self-sustaining or integrated, and what your conclusion is at the bottom. Are they self-sustaining or integrated? So we need some kind of conclusion. And I will join you on the next video. Bye.